Hello and welcome to Small Cap Nation. I'm Jane King at the New York Stock Exchange, and with me today Don Steinbrugge, the CEO of Hedge Partners, and we're going to talk about the hedge fund industry and what you see for 2017. So what are some trends that are happening? And the first thing, evolution in hedge fund fee structures for large institutional allocations. So explain that and what kind of changes do you see taking place
Sure.
there?
First of all, the hedge fund industry has received a lot of criticism about high fees.
Right.
And the hedge fund industry is responding to that because most of the money going into the hedge fund industry is coming from very large institutional investors that are putting a huge amount of pressure on hedge funds. So what hedge funds are doing is, one is they are scaling fees based on size of mandate.
Okay.
So the more you put in, the lower your fees.
Wow,
And if
okay.
you get over 100 million, you're probably around 50% of what the normal fee would be for a hedge fund. The second thing hedge funds are doing is they are negotiating fees with institutional investors.
Okay.
They're negotiating everything from management fee, performance fee, putting a hurdle rate in, meaning you have to earn a certain rate of return before you get your performance fee, crystallization period. And the last thing they're doing is they're coming out with hedge fund light products at a flat fee, very similar to the fee you'd pay for a mutual fund. So big picture is hedge fund fees are coming down significantly for large institutional investors.
Okay, I know a lot of people have been looking for that for years for that to happen. Continued outflows of assets from the hedge fund industry. We did see that happen last year by large institutional investors, but less than what people have expected.
Yeah, so there's a lot of pressure on public pension funds to get out of hedge funds. You know, there is a disconnect between most people's view of hedge funds and why institutional investors are actually allocating to hedge funds. So there's union employees, there's politicians that are all putting pressure on these public pension funds to get out. The truth is that most of them want to stay in, so you'll see some money continue to come out from public pension funds, but not anywhere near as much as you would think.
Okay, all right. Hedge fund industry assets to reach an all-time high in 2017. If that would happen, that would be the 9th year in a row.
Yeah, so basically last year you saw some money come out of hedge funds, but performance offset those flows.
Okay.
So the reason these pension funds want to stay in hedge funds is because they have to achieve a rate of return of about 7.5%, which is their actual rate of return. They can't invest it all in equities. On the fixed income side, you're only getting about a 3% return. And for hedge funds, they think they can get a 4 to 6% return, uncorrelated to the capital markets, and it'll also help them protect downside volatility.
Okay. Increased alpha due to decreased correlations and higher volatility.
Yeah, so basically it's been really hard to make money if you're a long-short equity manager because all stocks have been moving in the same direction. The correlation between stocks has been very high, and that's because you've had a very accommodative Fed. It's also kept volatility, or the movement of stocks, very low. And I think that's going to change with Donald Trump. You know, Donald Trump is going to change things.
Yeah.
And when you make changes, it increases volatility. And when you also make changes, it's going to affect different companies differently. It's going to affect different industries differently. So the relative movement of stocks is going to go down significantly, and I think it's really going to help long-short equity managers.
Okay. Large rotations of assets among managers based on relative performance and changes in strategy preferences. What does that mean?
You know, so basically there's a lot of investors that are very concerned about the capital markets. They look at the bond market and they think there's a bubble.
Okay.
Interest rates are still low, although they have gone up a little bit since Trump was elected. Also, credit spreads are very tight. They're also concerned about the equity markets. I mean, the PE of the S&P 500 based on forwards earnings is about 17.5. On trailing earnings is about 25, which is very expensive. So what a lot of these pension funds are looking to do is invest in hedge fund strategies that aren't correlated or don't move in the same direction as the bond or equity market. So strategies like CTAs, reinsurance, direct lending, relative value fixed income, market neutral equity are going to see growth, and those that have a lot of exposure to the capital markets are going to see money come out of them.
Interesting. Okay. Smaller managers will continue to outperform.
Yeah, so you know, one of the biggest problems in the hedge fund industry is 70% of the assets have flowed to managers with over $5 billion in assets.
Okay.
There's 15,000 hedge funds. Most of them are less than 100 million in assets. Only 5% of flows have been going to them. So the reason smaller managers are going to outperform is a lot of these hedge funds that are above 5 billion have gotten too big, and it's very difficult to generate good returns if you get too big.
Sure.
They've turned into basically, asset management firms from hedge fund firms. So small firms have a huge advantage in generating performance.
Okay. Increased flows to small and mid-sized hedge fund managers. So this kind of ties into that.
Yeah, so even though studies have showed that smaller managers outperform over time, most institutional investors have wanted to invest in the largest managers with the strongest brands. And what's happening is these pension funds are going through an evolutionary cycle of investing in hedge funds, where they start off by investing in fund of funds, they then buy the hedge fund manager with the strongest brands, and as they build out their team, as they get more sophisticated, they begin to invest in smaller and smaller managers. Their focus is more on generating returns than worrying about headline risk. So you're going to see more pension funds invest in smaller managers over the next 12 months.
Okay, high concentration of net flows going to a small percentage of managers with the strongest brands. So you mentioned the brands and how people have heard of certain hedge funds, but we're going to see net flows going to a smaller percentage of those.
Yeah, a good way to look at this is imagine if you were buying laundry detergent and you went to the store and there were 15,000 brands of laundry detergent. You'd probably buy Tide,
Right, yeah.
It's just so
Too many
overwhelming,
choices,
there's just too many choices. So that's going to continue to happen. You're going to continue to see a lot of money going to firms with the strongest brand, but you're also going to see some of these small managers create brands, through really good performance, through doing a lot of marketing and so forth, just the buzz of these managers. So most of the money is going to be concentrated to a very small number of managers, but there are going to be some small gems that are going to grow significantly.
Okay, now continued increase in hedge funds shutting down.
When you got 15,000 hedge funds, it's very competitive.
Not everybody can do it, yeah.
When you look at professional hedge fund investors, they're getting contacted by thousands of managers a year. They're meeting with 200 to 500 a year. They're doing a second meeting with 50, and they're allocating to 2. It's just a very competitive marketplace, and most of the managers are under 100 million. They're getting squeezed from the revenue side as hedge fund fees are coming down. The expense of running their operations is going up, and a lot of them are going to go out of business, which is probably good for the hedge fund industry. There's just too many hedge funds out there.
Okay, and positive flows to hedge funds of funds with specific industry niche experience.
Yeah, so hedge fund of funds are basically funds that allocate to other hedge fund strategies. So if you don't have a lot of expertise in picking hedge funds, fund of funds are a great way to go.
Okay.
And historically, they've lost a lot of money, and the reason they've lost a lot of money is institutions have been pulling out of them because they haven't wanted to pay a second layer of fees. Well, what is now happening is, since hedge funds are scaling fees, since they're negotiating fees, you get a lower fee if you make a large allocation. So that benefits a lot of these fund of funds. If you're a small institutional investor and you're not making a big allocation, it doesn't cost you more to invest in some of these fund of funds that have negotiated fees on the funds they invest in. So I think these niche fund of funds are going to see asset growth over the next 12 months.
Okay, very interesting, Don. Thank you for sharing that. I have a feeling it's going to be a very interesting year ahead for the markets and the economy. We're going to see a lot of changes, so thank you for sharing your thoughts with us today. Don Steinbrugge, the CEO of Hedge Partners, and thank you as well for joining us on Small Cap Nation. For more interesting companies and information about the market, you can go to smallcapnation.com. Have a great day.